Hello everyone, welcome back our channel. In this channel, normally we talk about hustles, side hustles, saving, budgeting, investing. Our eBay business, we started from very minimum capital from there, and then our journey to achieve FIRE movement.
In this video, we're going to talk about the difference between property investing as well as our ETF. So we've done dabbling on both, property investing as well as ETF, as well as other things in the middle. I figured if you were to do it all over again, which one is better?
So the thing is started from today. You got a phone call.
Got a phone call from, I guess,
very exciting. Yes.
Yeah, very exciting because this particular person, over the space of 2 years, two or 3 years or something, acquire roughly about 30 properties. Now that might mean a lot, or that might mean a little for some, but that's very impressive.
No, it's very. That's a lot in 2 years.
Yeah, that is a very impressive portfolio. Now, this particular person purchased the property in the lower end of the market, let's say, but even though I learned to diversify and minimize risk, you buy a bunch of different ones.
Yes.
So understandable, because that would be minimizing risk. And that got me really exciting. I'm like, whoa, man, like your income and your outgoing and your debt load and all that stuff got me feeling the fear of missing out. The FOMO.
FOMO again.
Yeah, and I'm sure, I guess when you go through this journey, you're bound to feel a little bit of that.
Remember when we first, a few weeks ago, we had a video about FOMO when we first started investing.
Yep.
Everyone is investing in property. You feel like, okay, at my stage, at my age, everyone of my friends, they're investing. And I have to do it.
The thing is, this person is a lot more older than us.
Yes, he's older. But he's very savvy and risk-taking.
Risk taker.
Yes, he is.
Versus us, because our circumstances versus this person is slightly different. We're young. We're
young kids.
We have kids, and so our risk tolerance level is a little bit more lower.
Yeah.
Versus
them, they are a couple.
They
no
kids.
No
dependents. No. And I guess they have the flexibility of that.
Yes.
Because they got no sibling or no.
No, they don't have any high fixed expenses, I would say. For example, having kids and dependent.
Yeah.
If you don't have a solid, don't have to be solid, but stable income, or that is quite risky, or you will feel lost sometimes. You like that sometimes.
Yeah. And on top of that, because they were both income, like high, moderate, middle, high income.
Not really, but both of them were full time before when we met them. Both of them were working.
Yep.
And then they know, okay, we're not getting younger. We have to be more savvy.
Correct.
They find but I really appreciate is they always think out of the box.
Correct.
And they do take a lot of risk and take the opportunity, but because they have the time, and also they can afford it. But for us, no. But anyway, the after that, the discussion with him, one of them, and then you did some numbers, and you're very excited. For example, give them example.
Wow. Okay, so for an example, with one of our property, let's say purchase price roughly about $300,000, with the rental income roughly about $300 per week. Yeah. Now, with their version is purchase price at about 200 and something, 250, let's say, on that.
$250,000.
Yeah, $250,000 purchase price, and their income is 300.
Yes.
Now, Arthur already had a good
cash flow
versus them.
Yeah.
But at the same time, I was amazed that they can acquire that many.
Well, they were using another method.
Yeah, different methods compared to us, and having, like, if you're having two income, like even if it's just one income, and then you don't have any dependent, that means the other person can focus on that.
The borrowing power or capacity is higher.
And the building wealth part of it, the fact that you have the time to do it versus us, whereas we're are time poor because we have to split between raising children, and as well as that, I guess doing day-to-day life, and then
essential work.
Exactly.
And spending time with the kids.
So our time is limited because of that. So I did have that FOMO feeling.
Yeah, you were so excited this morning. I'm like, slow down, chill, chill. Then we just have this conversation. Okay, so what happened? Like they did some of them were borrowing from the bank. They did a mortgage. And for us, we tried to minimize all our debt. And the first question I asked you,
what's the debt?
Is it K? No, is it, well, I don't mind buying property, but are you going back to the mortgage? Or you want to cash?
Like it's in pay in cash.
Pay off, yes.
Yeah, buy in
cash. Which one would you?
Buy in cash.
Buy in cash. Okay, so if you're choosing buy in cash, so we think, for me, I'm the number person. So if you buy in cash, $200,000.
Yep.
That property, you have to do a calculation for me.
Okay, let's do the numbers. Okay, so I'll just take out the calculator. Yep, go on.
Calculator. 200,000 is your value.
Purchase price.
Yeah, but then your rent, let's say, is 300 a week, right?
Yeah, so divided by...
the other way. 300 times, let's say the best. You don't have any vacancy, right? But you should. 50, just put 50.
50 weeks.
Yeah, 50 weeks.
So that means you get
15,000 as the rent only.
Yep.
But let's say we pay cash for the property.
Yep.
But you still got council, your water, and agent fee. Ignore it first.
Okay, we're just looking at the income of that. $200,000 divided by 15,000.
No, 15,000 divided by 200,000.
Divided by 200,000. I don't know where you're going with this, but okay. So 0.75
times 100, then you will be the yield of 7.5%.
Okay, so I don't usually calculate the yield much.
So that's your return.
Yeah,
that's your return.
Yep.
So what's the average of ETF's return?
Roughly, we're looking at about 10%.
So which one is higher?
Well, technically speaking, is the ETF.
And do you have any vacancy rate?
Well, markets goes up and down, but that's about it. That's your vacancy rate.
Yeah, not vacancy rate. It's volatile. So that if we choose to pay cash to buy property, then ETF will win. Because mainly it's the admin.
Okay, so that's the reason why we made this video. It's actually comparison between property versus, let's say, ETF, managed fund, or any app-based type of investment. So back to that, property, this is the reason why we make it.
Yes.
So in terms of entry point alone.
Yeah, for property you need 200,000 in that case,
in
plus
this
stamp
particular
duty.
Example,
Let's say nothing, assume 200,000. But then for ETF you can, if a proper one, you can do 1,000 or 500. But if you don't really have much, then you can raise a spaceship for $5.
Yep. So entry point, minimum on this macro investment.
Yeah.
Little as $5, which is your cup of coffee.
Correct. And then another point for me for ETF is you do it now, but the 200,000 you have to save it, let's say 10 years. So for that 10 years, where you're going to put the money? Do you put it in the bank with the interest, and how much interest can you earn? And for ETF, $5, and next week you put another 5, 10, 20, whatever money you have, and you compound it.
Yeah, so maybe you get a bonus, a big lump sum at the end of the month or something, at the end of the quarter of your work. Like, okay, then what do I do with this? Well, I'll invest it somewhere right there and then. Versus like, okay, then I'll put this towards my deposit on a property, or I want to buy a house outright, so this goes towards that house fund. Correct. So it might take a little bit longer. Yeah. What else is there? Oh yeah, you're talking about the rental yield, let's say. Yeah. So the return. I get confused with this rental yield because I looked at my cash on cash return, like how much money do I put in and how much do I get back? That's what I looked at. But if you look at rental yield,
it's the same. How much you put it in, you put 200,000, you get 15 back.
15 grand. Okay, so
so 7.5.
Okay, so that's how I guess investors calculate it.
Yes. That's your return.
Yeah, 7.5%, and that's a fixed income. As in,
depends
if your rental, you've got a tenant for 12 months, and that's how much they sign up for. You've got that income that every week. Without a doubt.
Yeah, if they're not moving.
If you're not moving,
yes.
Okay. Versus the market sometimes goes up, sometimes goes
volatile.
Sometimes goes
you
up.
cannot control that.
Cash flow wise, let's talk about cash flow. So again, same income with property, whereas sometimes you'll get dividends, sometimes we don't. Sometimes market goes up, the dividends get a lot more higher as well. That aspect. Yeah, and then the other one, the difference, which is the easier going in and going out.
Yes, for the ETF or any like trading, share trading, you can just do it on the phone or computer.
Yeah.
It's buy or sell. You can do it within few days. But then property, it is a long process.
At one stage, we tried to sell our property for it takes about a year before somebody actually purchased them, because the market goes down, it was going backwards.
And the price is not transparent. It's not as clear. You have to negotiate, and a buyer come and lowballing you, and you don't want it, and you wait for another one. But for share or ETF, the price is in front. You don't like it, you can't get it.
Yeah, you cannot take it or leave it. Whereas a property, there's a lot of data points here and there. That particular property that took us about a year or something to sell. The last sold was like, I don't know, a few years old. And there's no comparison sale in the building within the last 12 months.
And you got to pay marketing fee to the agent, pay commission to the agent, pay lawyer, pay the bank.
Sometimes the admin costs, it chew all of your profit. If you think that I'm making this amount of money, and if I sell it, you haven't counted all of the expenses that comes with it.
That's right.
So accessibility with ETF, you can access them on your phone, on your computer. Whereas a property is you gotta wait. You gotta wait until it's actually sold. So, anything else?
Leverage. Some of them you can use. Property, majority of the people, not like us, weird, thinking to buy in cash. But most of the people thinking to pay 10 or 20%.
5%, 10%, 20%.
But which means your return will be a lot less because you have to pay the bank as the mortgage. There's a capital gain in property, but the properties our client's been purchasing is in regional. He's not looking for capital growth. He's more looking on cash flow. So there are different kind of strategy with property you can choose. But at this stage, I don't know, personally, I'll still go for ETFs because of that admin headache.
If there's broken down,
insurance, the house burned down, vacancy, a lot of fix, repaint or the roof.
Repaint, change carpet, there's this repair, this just constant repair and repair and repair.
Yes.
So,
he acquired 38. Good on him, and he's managing by himself.
I was amazed. I mean, if you can do that, kudos.
It will be a full-time job.
Yeah. And because of that, I think that's the reason why they actually decided to do
it. Both of them stopped working for full-time, focusing on the property. But not. What if few of the property become vacant? Can they use all the income or the rent to cover the mortgage?
And vacancy rate, what if it's longer than expected?
Yes,
we work on averaging about 2 months. What if it's longer? What if you end up there's a lot of this
what if
because
it happened to us before and we are scared. I'm kind of scared for life.
You're scared for life once you've experienced the negative side of property. You're the risk involved with that.
And the responsibility.
Because it's not a small change. It's not $5.
Also, it's leveraged. It's very funny, right? When people play share trade with margin call, everyone's like risky because you're borrowing people's money. But when you purchase property using the bank's money as a mortgage, now it's good investment.
It's still
there's another point of view.
I think it's because on top of that, it's not your money, you don't feel it. So for us,
it's not my money, I feel more.
Because the consequences.
I have to pay it back if they're not paying me.
No matter what, I have to pay that back, and sometimes it's stressing me out because I've got this big burden behind my back. However, after owning, I guess, outright property, like there's no mortgage on one of my investment property, I feel a lot more relief, and I don't think I want to go back to that with mortgage. Because without a mortgage, we felt like if there's no tenant, that's okay.
Yeah.
If I have to reduce the rent, that's okay. If there's a maintenance, we look at it, okay, I gotta repair this in the long term, it's gonna add more value. What else is there? You look at it, sometimes you get a newsletter out of the mail with agents around the area, sell, hey, this property, same similar size, sold for this price. Like, okay, so I can see the value of that property goes up. Like all of that, so that means if next door neighbor or next street goes up in value, so I expect my one can probably in the same
similar price.
What else? I guess like it's a big chunk of money.
It is a lot of money.
When it comes to buying property, it's not be all and all, but you gotta remember, don't feel that FOMO feeling. So I had to like pinch myself, like, oh my God,
you were so excited. You were like, all in.
Let's go back.
He just hung up the phone. Oh,
look at these numbers. Oh my God. And like I thought, what is, if you got that plan in place, what are you trying to achieve? Follow that plan.
Thank you.
So I have to actually talk to myself about that. I'm like, that's not part of your journey. That's not
your strategy. Sometimes we're all human, right? You say, oh, it's working out for them. It will work on for me.
It should work for me because it worked for them. And it's somebody that you know.
And another thing is, well, it's good for them, but like, you acquire all this risk and it's too high. What if something not working out? Now we're just being very conservative. You going up high quick, sometimes you're just going down quickly as well. That's another point.
I think there's that saying, high risk, high reward, a higher return. For us, it's like, try and minimize risk as much as possible. Yes, it is going to be a bit boring. Yes, it's going to be very slow. But hey, that's so far it's working out all right for us.
It takes slow, but just trust the process. That's all I can say.
So if we have to choose between the two, if we do it all over again, let's say if
we pay cash only, no leverage, ETFs.
Okay, so if you have a bucket, hey, here's X amount of dollars, $200,000-$300,000 right there. What would you do? Which one would you do?
ETF. I don't like the admin. I don't want to like get agent and get a quote. They tell you, like, if you're trying to sell it, right? They always tell you the best price, impossible price.
You
can sell for 700 in real life, 550.
I know, like, hey, it's gonna be at 700. Sign this piece of paper. You're locked in with me. Like, oh, somehow the market changed. It now becomes 500.
Exactly.
So you kind of learn as you go along, I guess, with all of these things. Now, we're not saying that property is a bad thing. It's good.
It's just not our strategy. Now.
So it used to be our main strategy, but I realized, no, you know what? There's other ways that you can actually earn the
But if it works for you, go for it.
Yeah, I mean, if it works out, kudos. But it's not for us. The other one would be the fact that it's flexible. You can open it and close it anywhere in the world. With ETFs or with managed funds or with a phone call, you can just go down.
You don't even have to call them.
These days you don't. You can just go log into your account, close it. Whereas real estate, there's still all of these back and forth.
Sign the contract.
Exactly.
Get a solicitor.
I just looked at one of the property, and I'm like, oh yeah, I forgot. You need to get this. You need to get this. To get that document signed, you need to go here. You need to get this statement, that statement. You need like all of this admin paperwork involved. When you're overseas and you don't have access to all of those, what do you do?
You know what? I think in property will make money if you're in the business, like if you're agent or you're solicitor.
accountants, etc.
It's good.
I mean, for an average Joe Blow,
Mom and dad like us, nah, pass now, pass. Just give us headache. Yes.
Yeah, lots of headaches. Well, I don't know. It could be just our experience,
our personal experience.
Yeah.
So far hasn't been too good, but it works. Just not for us. We're just not good in that.
So for us, like to minimize that, I'm just gonna buy in cash. Less headache.
Yeah.
No leverage.
But then now, if we buy in cash, the return is not as good. So now just skip.
Anyway, that's just our 2 cents, guys. I guess our story of property versus ETFs, managed fund, and all of this
micro
investment, which what we've experienced so far. So far, that side is winning versus the property.
Yes. Anyway, hope you guys like these kind of topics. Subscribe and comment. See you next time.
Bye.